Why this Fed decision matters more than ever for most Americans. The Federal Reserve feels distant, a powerful institution operating quietly in the background. But every so often, the Fed reaches a moment where a single decision doesn't just move markets, it reshapes the entire economic landscape. The upcoming Federal Reserve decision is one of those moments. Over the past 2 years, the Fed has moved aggressively, raising interest rates at the fastest pace in decades. The goal was simple in theory: bring inflation under control. And on the surface, that mission appears to be working. Headline inflation has come down from its peak. But beneath those numbers, the economy is sending mixed and increasingly fragile signals. That's why this upcoming decision matters so much. The Fed is no longer just fighting inflation. It's trying to balance inflation control against financial stability, labor market weakness, rising debt costs, and stress inside the banking system. Every choice now carries consequences and trade-offs. If the Fed keeps rates high, borrowing remains expensive. That puts pressure on businesses, households, and banks. Mortgage rates stay elevated. Credit card balances become harder to service. Small businesses struggle to access affordable loans. Over time, this slows economic growth and increases recession risk. But if the Fed cuts rates too early, inflation could surge again. Prices might re-accelerate. Asset bubbles could form. The dollar could weaken. And the credibility the Fed fought so hard to protect could be called into question. This is the policy trap the Fed now faces. Markets understand this tension. In the months leading up to major Fed decisions, volatility rises because investors aren't just reacting to rate changes, they're reacting to what the Fed signals about the future. A single word in the Fed statement can move trillions of dollars. This decision is also taking place in a very different economic environment than past cycles. The U.S. government is running massive budget deficits. National debt is at record levels. Banks are holding large, unrealized losses. Commercial real estate faces refinancing stress. And global confidence in the dollar is no longer unchallenged. At the same time, consumers are showing signs of fatigue. Credit card delinquencies are rising. Savings are being depleted. Job growth is slowing, not collapsing, but drifting lower. The economy isn't in crisis, but it's far from strong. This puts the Fed in an uncomfortable position. Monetary policy usually works with a lag. By the time data clearly signals trouble, damage has already begun. But acting too early carries its own risks. The upcoming decision is not just about rates. It's about direction. Is the Fed signaling that inflation is still the top priority at all costs? Or is it preparing to protect growth and financial stability? Investors, businesses, and households are all watching for the answer. Because once the Fed shifts, even slightly, everything from the stock market to housing, from the dollar to everyday prices, begins to adjust. What the Fed is really watching to understand how the Federal Reserve might act. It helps to understand what it watches most closely and what worries it the most behind closed doors. Officially, the Fed focuses on two goals: price stability and maximum employment. But in practice, the decision-making process is far more complex. The Fed tracks hundreds of indicators, many of which never make headlines. Inflation is still central, but the Fed now looks beyond headline numbers. It watches core inflation, services inflation, and wage growth. Services inflation is especially important because it tends to be sticky. If wages rise too quickly, inflation can become self-sustaining. At the same time, the Fed is paying close attention to the labor market, not just job creation, but job quality. Are hours being cut? Are companies slowing hiring? Are wage gains cooling? A weakening labor market often signals economic slowdown before unemployment rises outright. But one of the Fed's biggest concerns right now is financial stability. Rising interest rates have exposed vulnerabilities in the banking system. Banks hold long-term assets that lost value as rates rose. Commercial real estate loans are under pressure. Deposit flows remain unstable as money moves into higher-yield alternatives like money market funds. These aren't problems the Fed talks about openly during press conferences, but they matter deeply. Financial stress can spread quickly, and once confidence breaks, containing it becomes difficult. The Fed is also watching credit conditions. Are banks tightening lending standards? Are businesses pulling back on investment? Is consumer credit becoming harder to access? Tight credit often does the Fed's work for it, slowing inflation, but also slowing growth. Global conditions matter too. The U.S. dollar remains the world's reserve currency, but global demand fluctuates. If rates stay high too long, global liquidity tightens. If rates fall, capital flows shift. Either path affects currencies, trade balances, and geopolitical stability. Then there's the debt problem. Higher rates mean higher interest payments, not just for consumers, but for the U.S. government itself. As older low-rate debt matures, it must be refinanced at much higher costs. This puts pressure on fiscal policy and long-term sustainability. Behind every Fed decision is a simple truth. There is no perfect option anymore. Every choice helps one part of the economy while hurting another. So when the Fed speaks, analysts listen carefully not only to what is said, but to what is avoided. Changes in tone, updated projections, and subtle language shifts all reveal how close the Fed believes the economy is to a turning point. How this decision could reshape the U.S. economy and daily life. The Federal Reserve doesn't just move markets on Wall Street. Its decisions quietly shape everyday life across America, often in ways people don't immediately notice. If the Fed signals it will keep rates high for longer, borrowing costs stay elevated. Mortgage rates remain high, keeping home affordability out of reach for millions. Rent pressure continues. Businesses delay expansion. Hiring slows. Over time, economic momentum fades. Stock markets could become more volatile. High rates reduce the value of future earnings, putting pressure on growth stocks. Bond markets may stabilize, but only if investors trust inflation will keep falling. On the other hand, if the Fed signals upcoming rate cuts, optimism may surge. Stocks often rally. Borrowing becomes cheaper, housing activity could rebound. But that relief comes with risks. Rate cuts can reignite inflation if demand returns too quickly. Asset prices can disconnect from underlying economic reality. Debt grows faster. Savers earn less on deposits. And the dollar may weaken as capital flows shift. For ordinary Americans, the effects show up in subtle ways. Credit card interest changes, auto loan affordability, job security, grocery prices, rent increases, retirement account balances. This is why Fed decisions matter even if you never watch the announcements. There's also the long-term issue of trust. The Fed's credibility rests on its ability to control inflation while maintaining stability. A mistake now, in either direction, could echo for years. History shows that major economic shifts often follow key Fed pivots. Rate cuts have preceded recessions. Aggressive tightening has triggered financial stress. The Fed knows this, and that's why it moves cautiously, even when markets demand certainty. The upcoming decision won't end uncertainty, but it will signal where the U.S. economy is heading next, toward stabilization, slowdown, or renewed inflation pressure. The real takeaway is this: the Fed is no longer steering a strong economy. It's trying to land a fragile one without breaking it. And when the Fed is this constrained, even small decisions can change everything. How markets react before and after. The Fed decides long before the Federal Reserve makes an official announcement. Financial markets begin reacting to expectations. In some ways, markets don't wait for the Fed, they attempt to front-run it. This behavior turns the period leading up to a decision into one of heightened volatility, speculation, and emotional trading. Bond markets usually move first. Treasury yields shift based on what investors believe the Fed is about to do, not what it has already done. When investors expect higher rates for longer, long-term bond yields rise, tightening financial conditions even before the Fed acts. When rate cuts are expected, yields fall, easing conditions without a single policy change. Stock markets respond differently. Equities tend to rally on the idea of rate cuts, but history shows that not all rate cut rallies last. When cuts happen because the economy is weakening, early optimism often gives way to deeper corrections. Markets don't just react to lower rates. They react to why rates are being lowered. This is why Fed decisions often produce strange reactions. Sometimes stocks fall even when rates are cut. Other times, they rise even when rates stay high. The market is constantly asking a deeper question. What does this decision imply about future growth, profits, and risk? Another key factor is market positioning. Large institutional investors adjust portfolios weeks or months in advance. If everyone is already positioned for rate cuts and the Fed hesitates, disappointment triggers sell-offs. If expectations are too pessimistic and the Fed sounds less restrictive than feared, markets can surge unexpectedly. Volatility itself becomes part of the story. Options markets price in larger swings around Fed meetings, reflecting uncertainty rather than certainty. This uncertainty signals that investors lack confidence in their economic outlook, a warning sign in itself. After the decision, markets shift focus to forward guidance. Investors dissect every phrase of the Fed statement and press conference. A single sentence about data dependence or persistent inflation risk can change market direction instantly. The Fed understands this dynamic. Sometimes it uses language deliberately to prevent markets from easing conditions too quickly. If stocks rise too aggressively or yields fall too fast, the Fed worries financial conditions will loosen prematurely, undermining its inflation fight. This creates an unusual situation where the Fed may sound more hawkish than it intends, simply to manage market behavior. The result is confusion, mixed signals, and sharp short-term swings. Over the longer term, markets settle into trends, but those trends depend heavily on whether the Fed's policy path aligns with economic reality. If the Fed misjudges conditions, markets often sense trouble first. In that sense, market reactions are not just noise. They are a real-time stress test of confidence in monetary policy. And right now, that confidence is fragile. The long-term consequences. What this Fed era may be remembered for. Every Federal Reserve era leaves a legacy. Some are remembered for fighting inflation, others for inflating bubbles. This period may ultimately be remembered for managing an economy overloaded with debt, fragile confidence, and limited policy flexibility. One long-term consequence of repeated rate cycles is normalization of instability. After years of intervention, stimulus, bailouts, emergency programs, markets now expect the Fed to step in whenever stress appears. This expectation reduces market discipline and increases long-term risk. Another legacy issue is debt dependency. U.S. households, corporations, and the federal government all carry higher debt loads than in past decades. Higher interest rates expose how dependent growth has become on cheap money. Lower rates may restore short-term relief, but they reinforce the cycle. The Fed's decisions also shape inequality. Asset prices respond quickly to easier monetary policy, benefiting those who own stocks and real estate. Wage growth and job security respond more slowly. Over time, this widens wealth gaps and fuels social tension, a factor policymakers rarely discuss openly, but one that matters politically. There's also the global dimension. The U.S. dollar anchors global finance. Fed decisions ripple through emerging markets, trade flows, and foreign debt markets. When U.S. rates shift, global capital shifts with them, sometimes destabilizing weaker economies. Over the next several years, historians may see this Fed era as a transition period, a move away from ultra-low rates towards something more volatile and uncertain. The old playbook no longer works cleanly. The Fed's credibility will depend not on achieving perfection, which is impossible, but on managing trade-offs transparently. Markets can tolerate bad news. What they struggle with is uncertainty without explanation. If inflation resurges, critics will argue the Fed moved too soon. If recession deepens, others will argue it waited too long. Either way, this period will be debated for decades. For Americans, the long-term impact will show up quietly. Slower growth, cautious lending, more volatile markets, and a greater awareness that monetary policy is not a cure-all. The biggest lesson may be this: the Fed can influence outcomes, but it cannot control them entirely. Forces like demographics, productivity, debt, and geopolitics limit what monetary policy can achieve. So when analysts say the upcoming Fed decision could change everything, they don't mean it will fix every problem. They mean it will shape the path forward, determining which risks surface first and which remain buried a little longer. Because in today's economy, the Federal Reserve is not choosing between good and bad outcomes. It is choosing between difficult ones.